welcome to Sectors Up Close. I'm Elena Casas. Today we're talking medical technology and my guest is David Sekera, Chief US Market Strategist at Morningstar. As the population ages rapidly in the US and Western Europe, demand for surgical products from knee replacements to cataract surgery is soaring. Historically, though, introducing new devices and diagnostics has been tricky due to high regulatory barriers, and pharmaceutical companies have attracted more funding for innovative development. The coronavirus pandemic also attracted more attention to the medical sector, but companies that invested heavily in COVID-19 diagnostics are now losing favour with investors as the pandemic falls out of headlines. This is the iShares Medical Devices ETF. It's down over 20% year to date, underperforming the wider market. Top holdings in this space include Thermo Fisher, Abbott Laboratories, Medtronic and Edwards Life Sciences. So, will medical devices have a healthier future? Let's ask David Sekera, Chief US Market Strategist at Morningstar. David, hi, thanks for joining us. We're talking here about stocks that generally did very well last year and during the pandemic, and they've lost investor faith a bit this year, haven't they? So why is that?
Well, the healthcare sector overall is a defensive sector, and as you would expect, it's actually held its value better, year to date than the broad market. So, for example, the Morningstar U.S. Healthcare Index has only fallen 11%, whereas the Morningstar U.S. Market Index is down about 17.5%. Now, from a valuation perspective, we do think that healthcare is pretty closely to fairly valued, and we do see better opportunities, in other sectors, from an undervalued perspective. However, within healthcare, we do see a lot of opportunities now for investors, specifically in the medtech space. So as you'd know, in this current risk-off environment, medtech stocks, certainly have sold off, quite dramatically, but we do foresee a number of advances coming up that we think offer significant upside potential for investors.
Do you think medical technology companies have overcorrected then in the last 6 months or so?
We do. And I would just note, medtech stocks in general got caught up and we just saw them skyrocket, during that disruptive tech bubble. And that really occurred, at the end of 2020 and then peaked in early 2021. I'd note most of those stocks at that point in time that we covered, we rated with either 1 or 2 stars at that point, just meaning that we thought they were trading at that point in time with, too large of premiums as compared to their intrinsic value. Since then, that bubble has definitely popped. Many of those stocks have fallen anywhere between 50 to 70%. And we do think the market has overcorrected. And looking at those same stocks that we cover, many of those are now actually trading in that 4 and 5 star category, meaning that we think that they're now significantly undervalued.
I know you want to single out some specific innovations that investors should be getting excited about. So what are these? I know one is cancer diagnostics, for example.
Well, within the medtech sector, probably the one area that I think we're most excited about and really focused on is really the potential for exponential growth in liquid biopsies. And what a liquid biopsy is that's a non-invasive method of diagnosing and analyzing for cancer using fluids like blood. And we think that would really represent a paradigm shift as far as when cancer is detected, as well as how it's treated. In fact, we think it's probably the largest potential market opportunity in the entire healthcare sector today. And according to our estimates, we think that could grow to about an annual revenue of over $30 billion by 2030. So when thinking about, why we're that focused on it, a couple of things that we're looking at is one, it will improve early cancer detection. It will boost survival rates and lower overall costs. And then 2 areas specifically that we're looking there are pan-cancer and colorectal cancer. So pan-cancer, we think that's an opportunity of $14 billion of revenue by 2030. And for colorectal cancer, $7 billion of revenue by 2030 as well.
So if investors are looking to expose themselves to this new technology, which firms are most interesting here?
Well, there's a couple that we're highlighting right now. So for pan-cancer screening, that checks for several different types of cancer in just one blood draw. So for example, Illumina's Grail can actually check for up to 50 different types of cancers in one blood draw. Now, we think that stock has certainly overcorrected to the downside. It's fallen to about 210 a share, which is a 35% discount to our fair value, and that puts that stock in that 4 star category. Now, I do have to also, note that with that stock, there's a lot of negative sentiment in the marketplace right now. They had recently merged with Grail. Now, the US FTC has ruled that the merger is not anti-competitive and is letting it go through, but the EU regulators are definitely taking a different view. They've announced that they intend to block the deal. So Illumina is currently appealing that decision, but even under that appeal, we've maintained our $307 fair value estimate. Now, in looking at liquid biopsies in order to check for individual indications of cancer, the largest opportunity there is in colorectal cancer. Now, currently, Exact Sciences Cologuard is the leader there, but we do project Guardant will catch up by 2030. So we forecast that by 2030, those two companies themselves will account for 2/3 of the liquid biopsy market for that type of screening. So Guardant stock, again, that one had peaked, I think, at like $160 a share in early 2021. We had rated the stock, with 1 star back then. Since then, it's fallen over 60%, trading at about $60 today. That currently trades at a 28% discount to our $82 fair value. And then Exact Sciences, a similar story, peaked in early 2021. Since then, it's overcorrected, falling 70% to about $40, and that trades at a 42% discount to our fair value.
David, how do these companies compare with other parts of the healthcare space? Because they're not the most defensive investments, are they? You mentioned yourself that there are a number of regulatory barriers.
Yeah, and it's definitely going to be for investors that can handle a lot more volatility in their portfolios. These stocks are going to certainly have much higher uncertainty ratings. They do not pay a dividend, but we do think they offer significantly more upside. And at this point, as much as they've traded off, as compared to our long-term intrinsic value, we think that they're trading at more than enough margin of safety for investors to get involved today.
Thanks so much for that, David Sekera, Chief US Market Strategist at Morningstar. Well, that's our look at medical technology. I'm Elena Casas, and this is Reuters.